City Fire Pension Fund investment meeting. We are at One Battery Plaza, 9th floor. Some attendees are participating via WebEx. Today is April 3rd, 2023. It is 9:54 a.m. Mr. Dunn, would you please start the roll call?
Yes, good morning, everybody. For Mayor Adams.
Shimon Ray.
For Controller Lander.
Controller Lander.
John Dorsa, alternate.
And for Commissioner Nybart Finance.
Kevin New.
Okay, for the UFA, Mr. Andrew Ansbro.
Bobby Eustace with Andy Angelo's proxy.
Okay, Mr. Eustace.
Virtually present.
Okay, Mr. Edward Brown. Eddie, you're on. You might be on mute.
Yeah, I'm on.
Okay, Eddie Brown present. Eric Bischoff.
Bobby Eustace with Eric Bischoff's proxy.
Okay. Thank you. Mr. John Young.
John Young, present.
Okay, for the UFOA, Mr. Christopher Jensen. Mr. Liam Guilfoyle.
Here.
And Mr. Jim Brosey.
Here.
And for Commissioner Laura Kavanaugh,
Lizette Krista here.
we have a quorum.
Thank you. We'll start with the public agenda. I will turn it over to the Controller's office.
Good morning, everybody. We have a short program in public today and one matter to discuss in executive. So we're gonna start by turning it over to Steve Meyer to give us an update before we talk about the strategic asset allocation. Okay, fantastic. So with that, Ed, are you on? He's behind me. Okay, so Ed, come to the table. Right at the head would be fantastic. So we're gonna have the risk report that we moved from last meeting to this meeting in order to accommodate the schedule of the board. So with that, I would like to turn to
Good morning, everyone. So we'll be talking about the Q4 risks. Can we have the slides, please, on the screen?
I'm pulling them up, folks. Just one moment.
Okay, thank you. Can we have the next page, please? Okay. So my goal for today is to give you a sense of how well your portfolio is positioned. Is it performing according to expectations? And obviously, your portfolio is almost 18 billion of assets. It's invested across all geographies, across all major asset classes. A lot of moving parts. So altogether, we think of all these moving parts as taking risks. And risks means uncertainty, but it's not necessarily a bad thing, right? As we all know, if portfolio has no risks, no exposures, we generate no returns. So the key question here, are the risks according to your expectations? Are the risks consistent with the investment policy? So we'll try to answer two questions today. First, we'll try to answer is whether the current positioning of the portfolio is consistent, it has any surprises, a question about today. And we'll try to frame the expectations for the future. Will the portfolio perform according to expectations going forward? So before we go on to this journey, we need to define what risk actually means. So there's no unique way to define risk. For the purpose of a large diversified multi-asset portfolio, we usually define risk in terms of performance. In particular, we define it in terms of probabilities. So if your portfolio is expected to deliver about a 12% return, we call it 12% risk. And in this case, we say that there's roughly 70% probability that your performance will be within this range, and about 15% probability of outperformance and 15% underperformance. And similar how we define performance, we have two measures of performance. We talk about performance in absolute sense, and we talk about performance versus the benchmark, relative performance. Just exactly the same, we have two measures of risk called total risk and relative risk. And at the end of Q4, the fourth quarter, the risk for your portfolio, you can see them at the bottom right, stands at 12.4% for total risk and 2% for active risk. But what do these numbers mean? Is it something you need to worry about? Is it gives you a sense of comfort? To understand these numbers, we need to kind of peel the onion back. So there are three main components that determine the performance and the extension of the risk of your portfolio. First of all, is the markets. It's by far the most important part. The second part is the asset allocation. Much like we define markets in terms of domestic equities, high yield, mortgages, all these moving parts contribute towards risk. And the last part, all the technicals that go into your portfolio, whatever the managers do, the cash flows, the benefits we pay out, the rebalancing, that's the actual portfolio. So let's take in these steps. First of all, let's focus on the markets. For this purpose, we construct so-called market portfolio, which is a 65 allocation to the MSCI World and 35% allocation to Barclays Act, which is global. Barclays US Act, which is the broadest measures of fixed income. And it's much like when you talk about the equity market, you think about the S&P, right? That's your market portfolio. Much the same, we construct a market portfolio, which represents your portfolio. So you can see this on the screen, on left-hand side of the screen. And in this large portfolio, we take essentially three types of risks and three types of exposures. We take equity exposure, which is simply defined by 65% allocation to equities. We take interest rate exposure, which we measure by duration. It's 2.2 years. And the credit risk or risk of default, which is represented by credit spread duration of 1.3 years. So this is our baseline. This is starting point for analysis. So we take this portfolio through our risk system bar one. And the results are shown at the bottom of this column one. You can see, excuse me. You can see that the risk of this portfolio, total risk, is 12.0%. So that means that we expect this portfolio to deliver over the next 12 months the absolute return of about 12%. And again, there is a 15% probability it will be more than plus 12, and about a 15% probability will be worse than minus 12%. So that gives you a sense of the portfolio risks over the long-term horizon, over 12 months or longer. The second measure of risk, which we call the beta to the S&P 500, is a more short-term measure in nature. So the beta will give you a sense how well the portfolio will perform for the changes in the S&P 500. And we use S&P 500 because one of the key factors of the global markets. Everything ultimately goes back to the S&P. This is your main risk measure. And you can see again at the bottom of the screen that the beta to the S&P stands at 0.61, which simply means for 1% change in the S&P, your portfolio will rally by 61 basis points. Okay. So just keep these numbers in mind, which we have on the screen. This is the baseline for our analysis. The other important point about this baseline is the change for the quarter. So you can see that the risk level ticked up slightly by about 10 basis points. And this being a market portfolio, we know it's driven entirely by the markets. So I suppose it's not surprising for anyone that the market portfolio went up in risks. I mean, we all know this is really extraordinary time, very unusual time in the markets, turbulent times, so the risk levels go up. So now that we have our baseline, let's move on towards your portfolio. So our first step is the asset allocation, the strategic benchmark. So your benchmark has 12 components, where the market portfolio is split into domestic equities, foreign equities, emerging markets, core fixed income, and so forth. So this portfolio is shown in the middle column. on the policy benchmark. And first of all, focusing on the portfolio construction, you can see that your benchmark is actually closely aligned with our market portfolio. The equity allocation is exactly the same. There are small changes in interest rate and spread duration, not huge, but take slightly lower risk. And what it means for risk levels, you can see it at the bottom of the screen. You can see that broadly consistent with market portfolio, but there are some changes. So risk level went down, which is a good thing. So for the same level of equity allocation, we managed to achieve low level of risk. It's comforting. And you can see also the beta is slightly lower. So everything is consistent when the standard benchmark. And finally, we can talk about your portfolio, which is on the right-hand side of the table. So first of all, you'll notice that the portfolio at the very high level is very similar to the benchmark. The equity allocation is the same. There's slight differences in duration, mostly because of the ETI program, but nothing really major. What it means for risks, you see that the risk level actually went up, and we'll talk more about why that is so. It's not a huge change, it's about 70 basis points more than your strategic benchmark. What's important is that the change in risk is consistent with the market environment. So it gives you a sense of comfort that the changes were not driven by something unusual, it's the markets. You see that the beta S&P again is consistent with the market portfolio, it's consistent with the benchmark. And here we introduced the third measure of risk, active risk. Because remember, we mentioned before, we have two measures of risk for total risk for absolute performance and active risk for excess returns. So here, active risk stands at 2%, and it simply means that over the next 12 months, you may expect your portfolio to deliver about a 2% excess return over the benchmark, with the usual disclaimer, 50% more, 50% less. It's all about probabilities. So I think this table is probably the main takeaway from this entire presentation. So this is your high level viewpoint, high vantage point. That gives us comfort that first of all, your portfolio is closely aligned with the benchmark as intended. And second of all, the changes in risks are driven by the markets. So this is a single affirmation with a very high vantage point that the portfolio is performing as expected. And related to this, there are two charts on the right-hand side of the page. So here we show the FIPA portfolio we just described, the evolution over the last 12 months. And you can see that this relationship we just talked about felt broadly the same over the last 12 months. You can see that in the months of November, the risk of the portfolio went slightly higher. It reverted back to as expected. And it's simply a reflection of the markets. And we'll talk more about it through the presentation. But broadly speaking, this relationship holds. Why it's important? It's telling you that nothing unusual really was happening in the portfolio. Right? So this is your check that the managers, everybody was doing as they expect. And finally, the last table at the bottom, this is active risk, which is a measure of excess return. Again, you can see a broad trend going higher, risk trend is slightly higher, completely consistent with what you read in the news about the markets. It's a very volatile time, came down slightly, nothing unusual, nothing unexpected. It's a good outcome. So this is a little bit of a bland pool. So we're applying a single number to a huge 18 billion portfolio. It's obviously more happening in this portfolio. So we'll dive inside and take a closer look at these numbers. Okay, next page, please. Yes. Yes, thank you. So you just mentioned that the total risk for your portfolio is 12.4% and active risk is 2%. What makes these numbers? What is the composition? What do these numbers come from? So first of all, let's focus on chart 1 on the left-hand side of the page. These are the components of your total risk. So here we show your total risk at a very high level, broken into public equity, private equity, and fixed income. So if you recall, your portfolio is 65-35, meaning 65% of equity and 35% of fixed income. Fixed income is the orange band. So you can see it's barely visible. So despite being a 35% allocation, fixed income contributes only 6% of risk. What it means, you don't expect much returns from fixed income in the current environment. What's more interesting, this orange band, the fixed income band, is on the same side of the chart as equities. Normally, we expect diversification. We expect equity bonds rally when equities sell off, the so-called negative stock bond correlation. We haven't seen it in about a year and a half to 2 years. And it's simply a reflection of a high inflation regime. Normally, when inflation runs high and increasing, stock bond correlation tends to be positive. In an environment of stable and low inflation, it tends to be negative. So as we expect the outlook, I think it's a general consensus, inflation is probably coming down. It's not clear whether it's next year or longer. As inflation normalizes, we expect the stock bond correlation to normalize and become negative again. Then we expect this orange band to move down. The other point to notice on this chart is the public equity band, the green band. So public equity is about a 42% allocation in your portfolio, yet it makes 64% of total risk. Again, what it means, you expect significantly more performance, be it on the upside to downside, coming from public equity. And probably the most interesting band is the blue band. That's private equity. And a light blue, which is other alternatives. So private equity being about a 10% allocation in the portfolio captures close to 20% of risk. So we know that private markets performed very well. We've seen excellent performance in generally counter-cyclical, or at least non-cyclical performance. It obviously comes with certain risks, and we see these risks on this chart. So the next point is to talk about active risk, which again, the measure of excess return. You see it on the right-hand side. The first thing that jumps at you is the color of this chart. It's all blue. Blue represents public equity. In the current environment, public equities contribute very little to excess returns. Fixed income, the orange band, is now negative. It's a manifestation of a positive stock bond correlation. Fixed income in the current environment actually detracts from the performance. Again, we expect this to revert in the future, and it's solely a reflection of the markets. It's not something that your managers did. It's not a result of the portfolio construction. It's a natural outcome. Private equity is clearly benchmarked against the Russell 3000, which is a measure more of a performance than risk, and that explains a high level of tracking error or active risk for the portfolio. So again, the important takeaway from this chart, when you think about your portfolio, you think about the expected performance, where you may expect the most of excess returns is private equity, not from public markets. So
I'm sorry, that question was not on the record.
Yeah, just when you think about your portfolio, in the public markets, you are very sensitive to those policy benchmarks, right? On the fixed income side, you have a very tight tracking error. You've given your managers very focused mandates with not a lot of leeway to get away from the beta, that policy benchmark, if you will, the component of that they're going against. And in the public equity space, we've got 70% roughly passive management on the large cap side. We've got a little more active management on international for sure. But again, the managers are baselining all their decision making against those respective benchmarks. So you tend to be pretty tight to those. And then with private equity, I think the context that I would draw is that we're using this public equity, the same benchmark, the Russell 3000, as a way to kind of proxy what they're doing. And they're not trying to pick companies within the Russell 3000. They're just going out trying to buy or manage private companies to, some kind of exit. And it definitely has a different aspect to it, as you could think of it as 100% active management, right? It's true active management without that really any reference point to that Russell 3000. So the model is kind of using that as a proxy, and that's just kind of the way the model thinks about it, if you will. And that's kind of the context I wanted to add to it. So it's not like we've made an active decision. I mean, you can say we've made an active decision to have a lot more tracking error or variability come from the private equity portfolios, and even to another extent, the real estate portfolios too, and other parts of the portfolio. But I think this is a little bit misleading in terms of context. It makes it look like we put all our eggs in one basket in terms of active management, and I don't think we have. I think we've been very thoughtful in the different pieces of the portfolio. Some of them are, more passively managed than others. There are not passive options in private equity space. There are not passive options in the real estate space, right? But this model uses the passive benchmarks as a way to represent those pieces of the portfolio, what's going on. That's all.
The only question I have, and it's only because you mentioned it, is in the European stocks, our active has underperformed unless recently it's improved, because I know Europe has done a lot better. But our active management in Europe had underperformed the passive, and just curious if there's any thought to going more towards passive, or we're comfortable with what we have right now.
I think part of this will be addressed by the forthcoming strategic asset allocation, but we'll also have a chart, page, I think 2 pages from now, that will dive into this. I think low level of active risk in public equity is partly a result of interaction between different sleeves. So we have IFA, US, and emerging markets. US is mostly passive, but not completely. So again, it's the level of active risk is unusually low, but it's again more of a markets than managers. If you look at the individual managers, level of risk is actually quite high.
So Steve, Ian, you might.
Nope.
All right. While I solve this, my question is, I just want to remind folks, we're in the midst of a search for IFA managers. And I think it's important we look at the final list of what gets presented to the board, that we look at how those managers complement one another and how they look against the benchmark. It would be a shame if we hired active management only to replicate what we're going to get out of the passive index. If we can find managers that were at least diversified.
You just went dead. I think you might die.
And we found a mix of managers that complemented the fact that we do have a small passive sleeve. But if we're going to be active, we should really consider being active and figuring out, which complement of managers would build the best portfolio or optimize the best return for us going forward. So I would just remind everybody, we're on the middle of that search, and hopefully in the next couple of months, we'll be seeing those results. And we should just really keep those things.
That again.
In my opinion, we should just keep those things in mind as we look at what the finalists are and what the construct of the final portfolio.
Yeah, if I could just add, I think that was the point I was trying to make, is that are we over the question I have to and for ourselves is, are we over diversified in active management? To Liam's point earlier about already maybe having higher conviction, higher concentration bets. And that's infrastructure, but it's another example. And it you also comment on the flip-flop on the active risk side for the trustees. The active equity risk becomes a detractor.
Well, I'm not sure it's a huge effect. I mean, if you look at the on chart 2 on the active risk, the green band, it's very narrow, first of all. And in the beginning of the year, it was additive to risk, as you would expect. In the second half of the year, it became negative, which meaning it detracts from excess performance, which is somewhat unusual. But given how small this number is, I wouldn't focus so much on the a flip of the sign. It's rather the magnitude that's surprising.
And if I could
Like normally we
add,
expect the green band to be much wider.
if I could add,
don't-
this is for a short-term time frame.
So we've
Yeah.
got John Merceberg. Can you speak up, John? We're having trouble hearing you.
Okay, so yeah, I would add that this is for a short one-year time frame, and Fire, is a long-term investor. And I'll also, note that 2022 was particularly bad for international developed, but the long-term numbers are quite strong. And I think we are planning to bring our search results and the managers to the board in May.
Great, thank you, John.
Oh, I had a question. Yeah. I had a question. You said the market portfolio was the active, is that?
Yes, it's MSCI Active and Barclay USA.
And when you talked about the we use beta for the policy portfolio, is that in the, when you talk about the policy portfolio, that's where you use the beta, right?
It's the beta to S&P 500. Yes, we show it across all three portfolios.
I was wondering, because it seems like our benchmark is often the Russell 3000, but I mean, I imagine there's a lot of concentration in the S&P 500.
Shuman, just go into the mic.
Your benchmark is represented by, it's a 12-component benchmark. We're talking about the strategic. And there are three equity sleeves. The US sleeve is captured by the Russell 3000. The developed ex-US is MSCI all countries, and of course you have MSCI, yeah. So if you put it all three together, the closest market portfolio will be MSCI Active. So there's just the closest broad market index that we would find.
But we're using the S&P beta as the policy market.
The S&P, we think the S&P is probably one of the most important risk assets globally. It's the largest, the most liquid market that drives everything. You're right. We can also pick, I mean, normally when we look internally, we'll look at seeing a larger number of indices and metrics. Risk is multidimensional, and it's very hard to condense it to a single number. So this compromise between brevity and capture. Yes, if we want to have a more in-depth conversation with you now.
Yeah, because I was also, we rarely see risk measures in the private markets. We get IRRs for the returns, which are easy. Yeah, I mean, there's a lot of moving pieces in an IRR calculation, and kind of the risk ratio we would get is a loss ratio. That's what I look at myself. We don't really get any kind of measurable thing of risk. Well, I don't think we get anything else in the private markets. We could talk about this later. And my other question was this negative correlation that's been 1.5 years, the positive correlation. When we do asset allocation, how will we look at that? How will we look at correlation for like a 10-year period?
Well, correlation, it is what it is. It's kind of given to us, right? So if you look at the stock bond correlation, like before about 1995, the correlation was positive. And it was specifically very positive in the 80s and 70s. Before that, it's probably not that much relevant because markets were not as liquid, different market structure. As inflation came down from mid-90s through over 2020, other than a few short period of time, the correlations tend to stand negative. So during global financial crisis, you have small short periods when it flip to the positive side. Usually when inflation runs low, you expect the correlation to be negative, and simply the way these gases behave, right? So in a way, it almost like an extension of your outlook at the inflation of the macro environment. Usually we're not in the business of forecasting the markets. I mean, it's a difficult game. I don't think we're not, I mean, nobody right around here. Very few people done it successfully over the time. I think our philosophy in general, we're more a passive investor. We long-term outlook. It's not trying to time the market. We're not trying to time inflation. right? So from this perspective, it's more of a longer term outlook. I think as we're starting the strategic asset allocation, we'll talk to across all consultants. That whole discussion was Doug. I think everybody's on the same page. It's more of a longer term outlook.
So that'd be a negative correlation.
It's essentially a gap baked into the assumption.
Because it just seems like this is such a critical part of asset allocation, the correlations, and particularly that one.
It is. I think if you believe in passive stock bond correlation, you're probably better off just putting all money in that. But it's a very small pool. I don't think anybody's prepared to make such a statement.
Thank you.
I have a question. So this is to what John Morsberg was saying about the time span on this chart. Is what is the value for us, given that we are long-term investors, in looking at this risk question on a 1 year, like on a quarterly basis like this, as opposed to a 5-year look back, or even, because this makes it look riskier than it might actually be.
Well, long term is made of a sequence of short terms, right? So just because we're long term investors doesn't mean we need to hide from the current exposures. We need to understand what it is. Long term means that every point in time needs to make sense. We need to understand this profile. It needs to be consistent with the objective, right? So if we have a benchmark, which is kind of the main measure of risk and performance, we want to see the portfolio perform closely and consistent with this benchmark along the way, right? I think the worst thing that long-term investor may experience is a drawdown. It's very hard to recover from a long drawdown. It's easy to compound the returns. Probably the best long-term returns achieved if you're like boring, steady, slow compounding. You're better off with a 10% returns year after year rather than having 50% followed by a strong drawdown. So that's, I think it's important to understand that the risks and exposure are consistent. When understand them, there are no surprises. Because the ultimate goal is to avoid these sharp drawdowns.
So this might be another slide, I don't remember, but are we looking at both then in this context of this conversation? Like just the last year and then a longer time span? Because I guess that makes sense that we want to understand what's happening in the short term, but it would be helpful to understand the context of like, this is the short term within the longer time horizon, as opposed to doing anything to sort of make any decisions, right? Based on.
Yeah,
So-
I agree with that. And I also think it'd be important as we do asset allocation. To understand those measures.
So all risk numbers we're showing today are calibrated towards a 12 months expectation. The charts you see here, just the historical evolution of these numbers over the last year, just to show the consistency and how they evolved over the time. It's actually since the world is unclear and unpredictable, moving from 1 year to 10 years is a simple multiplier. It's all scalable. So I think what's important is not the specific forecast horizon. It's the consistency in knowing what it is. But there's no magic between problems.
Okay, I'm sorry, and then I can stop, but I guess, isn't it true though, like in a year like the last one, like just thinking about, Bailey Gifford, for instance, right? And our active management on, well, where you could have 1 year where we're super off. And then the other 4 out of 5 years were 100% in line. Like, wouldn't it be helpful to be able to see that as opposed to just know the 1 year?
It's in 2 slides.
Okay.
Good question, but it's coming.
But the question around Bailey Gifford's actually legitimate, and John Mersberg can speak more intelligently about it, but they are a high conviction manager that, focuses on tech stocks and backup in yields, and their concentrated positions in tech. That's one of the drivers for their significant underperformance. I know when the market rallies, they tend to rally more than the market. So we still have confidence in them as a manager. But that really gets back to some of the points Liam made earlier about more concentrated risk and more of a focused portfolio.
Yeah, maybe so for the benefit of time, maybe we can skip 2 slides, which basically from everything is functioning as expected. One more, please. Into the next slide. Thank you. So here's that's probably what Alison was referring to. Here we look in more details and we can see the exposures in the performance at the individual asset class level. So this table captures the absolute and relative risk and performance. And the line items you see are aligned with the strategic benchmark. So the 12 components of the strategic benchmark. So we see individual asset classes. So first of all, starting with column 1, which is labeled as absolute, you see total risk, and you see which is the forecast for the next 12 months. You can see 1-year total return, right? We obviously realize performance over the trailing 12 months. So several things stand out from this table. So first of all, you can see that at the system level, the topmost line in this table, everything is consistent. We forecast the risk would be 12.4%. The return was a loss of 10.8%. It's well within the bounds, so everything as expected. For public equities, we see that the total risk level and total return are consistent, and the returns are bound by the forecast. No surprises. But the situation is quite different at the public fixed income level. So that's where you see the risk level being much lower than the realized negative returns. And to be honest, it's not surprising given the current environment. So I'm sure you've seen in the news how unusual kind of fixed income market is. So the drawdown in the US Treasuries, the last time we had the same drawdown, I had to go back to the 18th century. So these are truly historic times. The shocks we see in the fixed income markets are off the charts. So it's completely understandable if the risk forecast is not keeping up with the losses. And finally, on the alternative side, clearly performance has been very good. It's not aligned with the public market cycle. You can see private equity, as we mentioned, private equity is one of the largest contributors to this. Private equity delivered an outstanding performance at the high level of risk, but probably the line item most notable is private real estate. Right, so against this forecast of 15%, private real estate delivered almost a 20% return, which is unusually high. And if anything, it's something we need to watch going forward. It's probably unlikely to repeat and unlikely to continue. These numbers tend to revert over the time. And finally, we focus on the right-hand side, relative risk, which is active risk and excess return. Again, starting at the system level, the top of the table, everything is consistent. So we project at 2% active risk against excess return of 2.3%. It's broadly consistent. It's getting more interesting on the public equity side, and that's again back to what Alison mentioned before. Without naming any managers since we're in public session, you can see that active risk is much higher in developed market ex-US, as you would expect, where we use more active managers. And that's where, unfortunately, the excess return was not helpful. But you also see the asset diversification in action. You can see that excess return in the US equity is positive, developed ex-US negative. Altogether, kind of washes out. And at the public equity level, you see the excess return, not a huge number. It's minus 30 basis. On the fixed income side, active risk is well aligned with excess return, and that's again a statement on the managers. I think it's an important confirmation that given this volatile, difficult times in fixed income, your managers is performing as expected. And for private assets, I wouldn't focus on excess returns and active risk, as it's not representative for this asset. So the main takeaway, everything is functioning as expected. So now that we consider the performance, the risks and performance as of today, we need to talk about the future. So next up, we need to understand if the system will perform as expected going forward. So can we have the next page, please? So we clearly have no crystal ball. We don't know what the future will bring us. But what we can do is to estimate the expected market moves for the next 12 months. So we picked three main factors in the markets, and the main factors are obviously equities, rates, fixed income, and commodities. So within equities, we picked three markets, which is the S&P 500, which is a matter of U.S. domestic equities, MSCI EM, which emerging markets, and about half of it is actually China, and the Euro Stocks, which is the largest measure of European stock markets. So these three markets taken together represent about close to 75% the global equity capitalization. So it's a broad measure of equities globally. On the rate side, one of the most important global rates is obviously Federal Reserve policy rate. We use the 2-year Treasury as a proxy, and that's simply to reflect the fact that that it also incorporates the market expectations. Markets typically trade the expected Fed fund rates through the 2-year Treasury. The 10-year Treasury note is a proxy for the broad economy. So all mortgages are priced on the 10-year. Corporate investment grade typically falls off 10-year. It's probably one of the most important yield for the real economy. And the euro-dollar exchange rate. So the US dollar obviously has a very special role in the global economy. It's the world reserve currency, and the euro-dollar exchange rate is a proxy for the dollar. And finally, in the commodities, we picked three factors. First of all, copper. And copper is a proxy for the global GDP. So pretty much everything, almost everything being produced, starting from housing, cars, electronics, needs copper. And copper prices are highly sensitive to the expectation for the future global GDP. Oil goes everywhere. It's the transportation, it's manufacturing. The world stops without oil. And inflation, of course, is what we think about every day for the past couple of years. So we used our risk system to estimate the worst move that this market may experience, the worst monthly move over the next year. So you can see these numbers on the table. And the first thing that stand out, so these are really huge moves. So for example, we project that there is a high likelihood that that the stock market may have a 30% meltdown over the next year. To put this in the context, so this table was prepared about 3 months ago. So we show a 1.4% move for the 2-year Treasury note, which seems like a huge move, historical unprecedented. That said, we had 2 weeks around the Silicon Valley Bank event when the 2-year Treasury note moved by 120 basis points. So we didn't target that, but our forecast was kind of, unfortunately, was validated by the recent history. But again, these are big numbers. The euro-dollar exchange rate moving by almost 11%. It's unprecedented, unheard of. You can also see like oil price would forecast almost 60% shift. But keep in mind, within the last 2 years, oil price went from deeply negative to $120. So as big as this number is, it's consistent with the current market environment. So what does it mean for your portfolio? You can see it on this page. So we ran 9 stress tests for the up scenario and down, risk on, risk off, for the portfolio and for the benchmark. So altogether, we present here the results of 36 stress tests. And I'm not going to read the numbers, but let me just focus on the main highlights. First of all, I'm focusing on the risk on, which is on the left-hand side, focusing on equities. By far, the largest impact is the S&P 500. And I take a lot of comfort from seeing this number, simply because, I mean, clearly your portfolio has large exposure to the US equities, but allocation is not the same as sensitivity, right? So as we know, a lot of US companies have large operations abroad. In particular, given the current environment, what's happening with China, potential decoupling, you see the exposure to MSCI EM being the lowest number meaning your portfolio is probably least sensitive to China. It's not a bad outcome in this environment. And historically, US equities delivered probably the best performance over the last decade. Probably the most interesting outcome is on the rate side. So your portfolio is actually not that sensitive to the changes in the Fed fund rates. So the sensitivity to 2-year treasury since 1.3%, actually slightly up from the previous quarter, but the number is still not that high. What drives your portfolio? It's the dollar. So you can see that the euro-dollar exchange rate, 6.5%, is by far the largest contributor on the rate side. And finally, in the commodities, which is real economy, it's the copper that's most important. It's even more important than inflation. And just remind you, copper stands for the GDP. So to summarize, the main factors that will drive your performance of your portfolio is the domestic equities, the dollar exchange rate. So for finally the price of copper and inflation. So as you read the news and as the world is evolving, using these results, you can kind of see what will drive the portfolio. So what are the main conclusions from this table? So first of all, we see that the portfolio is projected to perform consistent with its benchmark and doesn't hold any surprises. So it's a positive outcome. The second conclusion is you see that your portfolio is ranked at slightly higher risk levels than the benchmark. Why I can say that? In the risk on table, all returns are positive. And the risk off, they're negative. So performing slightly better in the rallying market and slightly worse in the declining market. And the last takeaway from this page is that there's little downside protection in the portfolio. So you can see the risk on, what comes in, taken away by the risk of environment. So there's not much in terms of downside protection.
Ed, when you think about this model, when you talk about the downside protection, what would be the key things that we could do to the portfolio to increase the downside protection in your mind?
I think it's something that we'll be talking about as part of.
You're good.
As part of the strategic asset allocation, there's several asset classes that may provide downside protection. Some types of hedge fund strategies is sized to a certain level. Some CTA strategies potentially, some inflation protection, or in some extreme, they're so-called tail hedge protection strategies that rely on derivatives. So they all come with certain trade-offs, some of them being high level of complexity. I think it's one of the questions we'll be discussing as part of the asset allocation exercise.
So not what about cash or fixed income? Any thinking there?
I think if you talk about core fixed income, it's probably hard to find much diversification. So we need, loosely speaking, we need to find instrument. We need to find instruments that respond differently to shift in markets. What I mean by that, if the S&P goes up by 1% and goes down by 1%, right? For 1% move, you need to capture more of the upside, but for the down move, you need to cap your downside. Maybe sounds missing, I'm talking too much. A classical instrument for that are options. So clearly, easiest way to achieve downside protection is just simply buy put options. But that's a very costly exercise, and over the time it tends to detract from the performance, and it's not very efficient.
It's also been It's also been a challenging environment to operate in, coming off of a 40-year secular decline in interest rates. Really, we're kind of bare bones in terms of yield opportunities, and that backup was pretty significant. As Ed pointed out, it was somewhat unprecedented. I shouldn't say unprecedented; it's rare, but it has occurred in the past where equities and fixed income move in the same negative direction. That's what we saw in 2022. Also to Ed's point about tips, I mean, we still have a duration exposure associated with tips. So even though tips outperformed nominals on a relative basis, they still delivered about a 6% negative return in 2022.
I had a question. This is sort of interesting, as I learned rotation right there, like the 2-year Fed rate. Into markets rotations. The copper, and you're using that for like a GDP, approximate GDP to look at the market expectations. We have very little exposure to commodities directly. If that's such a big factor in the economy, of course, our exposures through our equity exposures as well. But the hedge fund portfolio is the only place we have some commodity exposure. Would that be something? Increasing some sort of commodity exposure, would that be something to make the portfolio more aligned with sort of direct factors?
It's not a simple question. It's not a simple question because there's no consensus and historical record is mixed. So that different strategies in some commodities-based strategies may provide inflation protection, may provide diversification. The problem is not consistent. If you take exposure to commodities directly, they actually do not provide a good inflation hedge. Probably your best long-term hedge against inflation is equity. That's exposure to commodity futures or CTA type of strategy or trend following strategies may provide a high degree of diversification and inflation protection and also downside protection. So it's something that I think we should explore.
So before we go down that road, I think this segues into the discussion that we're having next on the agenda, which is the asset allocation. And I think that is the board's best opportunity to ask questions about strategies that we're not currently using now, investment and asset classes that we don't use today that may be beneficial in the future. And I think that's the perfect segue to get us into that. So Ed, I'm just going to ask, is the risk portion complete or do you have another slide on risk? And then there's, well, we're going to do a break. You want to do it right now? Well, hold on. Ed, are you done with the risk?
No, we're done.
Okay. So let's take a 5-minute break and then we'll come back and we'll start in with the strategic asset allocation.
Hey, John, your new nickname is John. Don't go down that road, Dawson.
Noted. All right. So we're going to reconvene the public session of this meeting. I want to remind everybody that we're still in public session. We're going to turn it over to Steve for a couple of opening comments. Then we're going to get a view of the asset allocation, a 30,000-foot view from Ed, and he'll continue to go down a little bit further. And then we're going to turn it over to Doug to drill down a little bit deeper. Please, trustees, feel free to ask questions and engage in this process. That is the design of us having these meetings early on in all of the planning so that we know what people are interested in. We know what questions are out there and that the Bureau of Asset Management can carry out their part of this and so can NEPC to help and create a plan and a couple of options for asset allocation that the board can really discuss and debate and hone in on. So with that, I'm going to turn it over to Steve to give us some opening remarks.
Great, thanks, John. Am I on? Before I turn over to Ed, just a couple quick remarks. Obviously, the passage of additional legislation at the end of last year around the basket clause and the increase of that percentage from 25 to 35% may, and I say may because I don't want to pregame this, may give the trustees additional flexibility around certain types of alternative assets that we would want to incorporate into the strategic asset allocation plan. Just a couple of quick comments in terms of where we are in that process following the governor signing, again, that changed legislation in the law last year. Working with the Chief Strategy Officer, Allison Hirsch, we established a timeline for this important work for 2023. I also put together a team within BAM to spearhead the project, chaired by me, but also involving DCAOs Petra Nikolova, Nanash Pizzella, head of our equity, John Mercerberg, head of fixed income, Robert Fang, and last, certainly not last, at least is Ed Berman, our chief risk officer. We've reached out to the general consultants, obviously including Doug and NEPC. It's been great, easy to work with, and we've been collaborating. I think, Doug, we've had at least 2 calls at this point. Really trying to understand and review the capital market assumptions and the assumptions that underlie those assumptions. Those are Ed's words. We're also working with consultants on putting together a project plan just in terms of how we execute this against the timeline that we put forward earlier this year. And Chief of Staff Kate Visconti is actually working with us on that initiative. We're also planning for active engagement with trustees. So it's not just to come and present, it's also to make sure you understand, appreciate, we can answer your questions as we go down the path. But our hope and expectation, our plan is to have this wrapped up and hopefully in front of the trustees for approval in September, ultimately getting hopefully done by October so we can incorporate the changes, if there are any, into our pacing plans and private assets for 2024 and beyond. In early January, at the start of this process, I emailed to the BAM asset class heads and I included Ed Berman on the note. I detailed the 10 forward-looking themes that I thought we should incorporate into our thinking around strategic asset allocation. Ed, without my even asking, actually rewrote the slides, put them into a much more digestible format, and really kind of simplified the whole process into just 3 broader themes. With that, I'm going to turn over to Ed to actually go through the analysis that Ed's put forward, some of the themes we put in place. And the objective here is really to work closely with the consultants, but to have a forward-looking mindset as we look at asset allocation for your plan. So with that.
Thank you, Steve. Can we have the slides on? Next page. So asset allocation is obviously the most important decision that the plan can make. About 90% of returns is driven by asset allocation. The rest of it is from managers. And, it's a technical process. It involves steps like mean variance optimization, it has a lot of jargon, which ultimately are not that important. But fundamentally, asset allocation has 3 important steps. So the first step is to determine so-called long-term capital market assumptions, which simply our expectations for returns for all asset classes over the next 10 years. Step number 2 is select the asset classes that go into the portfolio. And the last step is a quantitative step when we perform statistical optimization that, given the assumptions, produces the results. I would say the first step, this long-term capital market assumptions, is by far the most important step of them all. And people always say that this time is different. It never is, but I think this time we may say that could. And why we say that is simply because the last 25 years may not provide a reliable guidance for the future. And why 25 years is important? There's no single way to do long-term capital market assumptions. So different shops will assume different methodologies. But broadly speaking, there are 2 high-level approaches. On the one side, some people just apply mechanical extension of historical trends, where you look for historical averages or otherwise, and just mechanically extend the form. On the other hand, you may say that history is history, and we think about the future, and we'll just come up with the approach that we think reflects the future economy best. In reality, a lot of people just find some kind of compromise between these 2 approaches, find a blended approach. But no matter what you use, you always back to the past 25 years. And why do I say that? We do not have much of reliable history beyond this period. So 25 years take us beyond the dot-com bubble. a lot of stocks that currently in existence weren't even issued before that. The markets were very different. And whether we use a mechanical extrapolation of history, 25 years, or whether we do more like our best ideas about the future, keep in mind that the people who make decisions today, the people probably in their mid-50s, used to be the junior analyst in the late 90s. And all of our understanding and our psychological bias is influenced by the past history. It's always there. But the last 25 years were quite unusual. So if you think about the major historical crisis, major events of the last 25 years, we start with the dot-com bubble, the year 2000, which, as traumatic as it was, is a more of a run-of-the-mill financial crisis. When stock go up, stock come down. It happens all the time. Take back all the time, but it happens quite often. This was followed by the global financial crisis, 2008. That was unusual. So we need to go back to the 1920s and 30s to find something similar. So the financial crisis of this magnitude tend to happen once every 100 years. It's a truly traumatic event. I would say even today in 2023, we're living through the aftershocks of this event. That was followed by the European debt crisis, which you may think almost like an extension of the global financial crisis that took several years. And finally today, starting from 2020, living through the pandemic, living through the war, living through inflation. The best comparable period I can think of is 1918. Again, more than 100 years ago. I don't know what the future will bring. One thing I know for sure, it will be very different from the past 20 years. So with this in mind, what are the main ideas? What are the main themes that will determine the future? So the world is very complex, and it's very hard to distill everything into a few taglines. But can we go to the next page? But the three main themes, the three main factors to think about are the inflation, the GDP, and the uncertainty. And we'll talk about them in more details. So inflation is always something that we thought would never happen again. For many years, we lived without last period of high inflation was in the 70s and the 80s, which is almost beyond the professional lifetime of most people active today. Inflation came back, and it will influence our future for many years to come. The GDP growth is something that underlies everything. It's the economy, it's the markets, it's the return to the system, it's the employment and consumption. Everything is GDP. Again, we'll talk about it in more details. And finally, the uncertainty. So we call it radical uncertainty. It's actually not our term. It was coined by Mervyn King, the former governor of Bank of England. Again, we'll talk while we put it as a third theme. So as we'll go over these themes for every point, we'll answer three questions. Well, first we'll consider why it is important. What's the impact of this theme on asset allocation? Then we'll consider what drives, what's behind these numbers. And finally, we'll consider what's the best way to express these views in the asset allocation. So starting with inflation, theme number one. So why is inflation important? I mean, inflation clearly just a change of prices. Intuitively, nobody likes when prices rise. As a matter of fact, there's empirical research that people almost knew, so people don't notice inflation until it reaches about 5%. Low inflation is actually also quite dangerous. Inflation serves as almost like lubricant to the economy. When the economy slows down, the companies can stop increasing nominal wages. That acts as a countercyclical stabilizer to the economy. So for this reason, most of the central banks pick the 2% target inflation. Not too high, not too low. There's actually not much science behind it. It's not came together somewhat accidentally. What's more important about the inflation is the uncertainty. It's the change in the inflation. And the change in inflation discourages consumers from buying goods because they don't know the price for tomorrow. It discourages businesses from investment for the same reason. And to change in inflation volatility slows down the economy. It's by far the most dangerous. Inflation clearly increases the cost of servicing debt. Like anybody who has a variable rate mortgage will not very happy. On the other side, everybody who has a fixed rate mortgage is actually doing not too badly. Inflation, we talk about inflation as a single number. There's actually a broad range of inflations. Like even domestically, inflation in Northeast tends to run at a lower level than inflation in the Southwest. The situation is much worse in Europe. Like a few days ago, Spain reported that inflation dropped from about 6% to about 3%. At the same time, in Estonia, a small country, inflation is running close to 18%. Just think about the European Central Bank using a single policy tool to address such a broad range of inflation. It's hard, it's more uncertainty, and it makes the job much more difficult. Inflation tends to reduce real incomes. We talk about the price wage spiral. The reality is that the real wages tend to fall behind in the inflation environment. So real wages decline, meaning consumers have less propensity to consume, meaning companies have need to produce less stuff, which means the economy slows down. Inflation is highly disruptive for emerging markets, specifically for any country that imports food. So for high inflation, it's a real chance that people actually go hungry in some of the countries where agricultural commodities are priced in the dollars. And as bad as inflation is, and as bad as inflation volatility is, what's actually worse is deflation. And my most favorite example is if you think about the Weimar Republic and the rise of Nazi Germany, this commonly framed that inflation that led towards the election of Hitler. It's actually not inflation, it's the deflation that crippled the German economy, and the deflation was one of the main forces that contributed towards the Nazi winning the election. So, what drives inflation? Yeah, the next slide, please. The short answer, we don't know. So there used to be time, maybe 10 years ago, when there was a commonly accepted view that inflation is a result of monetary supply. I think most economists admit at this point that the situation is much more complicated. We'll put here a quote from Oliver Blanchard, who is the former chief economist of the IMF, said that inflation is fundamentally the outcome of the distribution conflict between firms, workers, and taxpayers. It stops when the various players are forced to accept the outcome. Just think about this quote, this definition. It's complicated, and there's no clear way how to resolve. We have some ideas of what contributes towards inflation and why inflation was so low before COVID. One of it is the globalization, in particular rise of China. Specifically after China entered WTO, the World Trade Organization, as a lot of manufacturing was shipped off to China through the low wages, it drove the prices down, which reduced inflation. We know that the state intervention contributes materially towards inflation, and it goes both with fiscal and monetary policy. And of course, monetary policy is the main way how the state regulates inflation. We know that the pattern of global consumption income distribution contributes towards inflation. So we know about the wealth and income inequality. As more of GDP shifts towards wealthier part of the population, we have low propensity to consume, meaning less consumption, prices go down. Geopolitics is a huge contributor towards inflation, and clearly the recent event, the war between Russia and Ukraine, enough to be said. And finally, the role of dollar in the global trade and financial flows. It's actually a more complicated question, because through the global role of dollar, we essentially export inflation to other countries, and then we import it back through imported goods. But we know that the global dollar has a role in inflation. So what does it mean for asset allocation? The next page. There are ways we can express inflation through asset allocation. And here we consider two extremes, the low inflation environment and the high inflation environment. Just as we talked a few minutes ago, the low inflation environment tends to come with a negative stock bond correlation, meaning bonds rallies when equities sell off. It's good for the 60-40 portfolio. It's good for multi-asset investor. At the same time, the role of fixed income in the portfolio is reduced. So in this case, we think of fixed income more as a, we'll say, risk diversifier, so we'll push and flows rather than source of income. And finally, on the equity side, it's the growth equities that benefit. Think about the internet and technology stocks, the benefit in a low inflation environment. And private equity tends to have a strong tailwind, mostly through the low cost of funding. On the flip side of the equation, in a high inflation environment, the stock bond correlation portion is positive. It's not very helpful, but treasuries and credit now have a very strong role in the portfolio. They provide strong carry, and with interest rates already as high as they are, we can have high yield at 7 to 8% coupon. On the equity side, it's the defensive stocks that will benefit. Think of value stocks. Commodities may benefit under certain conditions. It's not a clear cut. Real assets may also benefit under certain conditions. Think of infrastructure, real estate, but again, it's not a clear cut. So that's inflation. The next theme that's important is allocation of the GDP. And here we're talking about the real GDP growth. And the difference here is the nominal is the number that's being reported. The real, stripped for inflation, is what matters. So we call about the GDP, which is gross domestic product. The other name for the same metric is GDI, gross domestic income. So it's all the income generated by the economy. It's income produced by the companies, which goes to corporate profits, it goes into stock returns. It's the income paid on the fixed income instruments. It's the income generated by the consumers, which of course goes into the consumption, into buying stuff, expands the economy. So the growth of GDP is one of the most important contributors that cascades through the entire economy and the markets. It's one of the main terms of the returns. Clearly, the high GDP environment will support strong employment, support strong consumer incomes. But also think about the impact of the GDP on the interest rates. You can think about the rate on the 10-year treasury note as over the time converging to the GDP growth rate. So in a low GDP growth environment, you may expect yields to stay low. In a high GDP rate environment, the yields will be high. Clearly, the GDP growth will influence the central bank policy. Usually when the economy overheats, when the GDP grows too fast, the central bank, Federal Reserve will step on the brakes. And ultimately, the GDP is one of the main parameters that goes into asset allocation. So what drives GDP? Get the next page. So here we have a single formula for this presentation. And simply put, there are only two factors that determine the GDP. It's the labor and the productivity. It's a combination of labor growth and productivity growth that influence the GDP. So let's take them in steps. First, let's focus on the labor growth, which is on the left-hand side. So we all heard about the declining fertility, especially in the developed world. Probably the only region where it's still running above the planetary rate is in Africa. Most of developed countries have fertility rate which is significantly below 2.2, which is neutral rate. We're actually doing not too badly. In this country, the fertility rate is about 1.8. The number is probably worse in South Korea, which is close to 1.1. Across Asia, numbers are very low. In Europe, numbers are low. So clearly, as the labor supply shrinks, the number shrinks, the GDP will slow down, just a natural process. There's several twists to it. There's a question of aging demographics. So we'll know about more people retiring and few people entering the workforce. The other question is the labor force participation. simply, it's not just the fertility, it's not just number of people, it's actually how many people participate in labor, how many people are working. And that's why actually, even though our demographics are probably better than the rest of the world, our labor force participation is lower. We're like about 62.4%, actually slightly lower than the pre-COVID days. The other parameter is labor migration. So as more people move into the country, it provides more labor and the GDP. And of course, we have a question of retirement age, right? So we've seen what's happening in France right now. We're trying to move the retirement age from 60 to 64. We also retire at 65, but there's a lot of statistics showing that more and more people come out of retirement to the part-time, full-time. People work well past the age of 70. So there are a lot of moving parts. It's very hard to say how it will play out. The secular trend for the labor supply to trend down. But I would say longer term projection, we're probably in a better shape than the rest of the world, especially like China, Asia is probably in the worst position possible. The other side of GDP growth is productivity. And for reason not fully completely understood, the productivity is low and decline. Productivity goes through cycles. Probably the highest level of productivity was in the late 19th century. It was related to the invention of steam and electrical power. But the process is not linear and long. Like give an idea, the electrical motor was invented in the 1860s. The wide adoption of electrical motors for manufacturing happened only in the 1920s. So it's about 50 years before the world figured out how to use electrical motors in a productive way. There was a lot of expectation when the computers came about, it will drive the productivity higher. They did, just not as much as people expect. So if you look at the productivity in the 1980s, there was an increase from the use of computers, and that started coming down. I can tell you anecdotally, like this presentation, look at the presentation, the content of the presentation came together probably 2 to 3 hours. Then we spent several weeks laying out the charts, the fonts, and everything else. It's probably happening everywhere. There's a lot of expectation for artificial intelligence right now. We just don't know how to play out. Chances are it will take a long time for the AI to cascade through industry and find its way to the real productivity growth. So we know several parameters that influence the productivity growth. We know that the fiscal and industrial policy, the state policy, may contribute a lot through research investments and through creating a better environment. We know the technology and AI may produce an impact, we just don't know how. We know that large and persistent trade imbalances globally contributed to the low productivity growth. And think about it like in the past 20 years, it was easy for the companies to outsource the manufacturing to China in low labor cost locations rather than to invest in productivity. Again, as this process goes in reverse, it may have an impact on productivity. But be it as it is, we know that the environment of low labor growth and low productivity growth, the GDP will grow slow. So how do we express the GDP views? Look at the next page. Again, we'll look at the 2 bookends, 2 extremes. In this slow GDP growth environment, we expect interest rates to stay low, which will reduce the attractiveness of fixed income. We expect the growth equity to deliver better returns than value. That's exactly the environment of 2010s. We expect private assets to have a tailwind, so allocating private assets will be beneficial. And we also expect more speculation. We expect more bubbles. Think with crypto. I'm not making a statement of crypto otherwise, but it is related some way to a speculative environment. On the flip side of the coin, in the fast GDP growth environment, you may expect interest rates to stay higher, which will benefit interest rate products and credit products. you expect value in small cap stocks to deliver better returns, which is probably a more natural environment for equity managers. And you may expect hedge funds to have a better chance to outperform. And I frame it fairly carefully because hedge funds come with a broad range of strategies and managers. And that brings us to the theme number 3, radical uncertainty. So you may think that the world getting more uncertain. We always think the world is uncertain, but it's actually something we can measure. There is a world uncertainty index that's maintained by the IMF, and it's available on the internet. And if you look at the 1970s versus today, the world uncertainty almost doubled. So it's actually a fact the world's getting more uncertain. And there are 2 types of uncertainty. They're so-called known unknowns. Something we know will be a source of uncertainty in the future. And it's, of course, is a climate transition. So we know it's here. We have some projections, but the truth is we don't know how climate transition will play out. It's the impact of Chinese economy. And China accomplished enormous economical development. 30 years ago, it was one of the most backwards countries in the world. Right now, it's number 1, number 2 economy. But Chinese economy cannot grow as fast as it did. It needs to restructure. We don't know how it will play out. China does not know how it will play out. Given their role in the global economy, the transition of China will be an enormous uncertainty for everyone. It's the geopolitics. So obviously living through the conflict between Russia and Ukraine, it's just one of them. There are many frozen conflicts in Africa, in Asia, in Europe, in the Middle East. It's everywhere, and these conflicts may explode at any point. It's the question about the US dollar in the future monetary system. We talked about it a little bit today. It's a complex question. It deserves a separate discussion. It's probably fair to say that for the next around 5 years, the role of dollar is safe. Beyond that, it's hard to say. But the monetary system will evolve and have strong consequences for the world. It's the access to natural resources. There are actually only 2 countries in the world that's completely self-sufficient in terms of natural resources. It's the United States and Russia. Every single country in the world relies on imports of commodities. If you think about what happened in Europe in the First World War and Second World War, a lot of it was about access to commodities, German access to oil in particular. It's the polarization of national politics. So obviously we all follow our domestic politics, but it's actually happening everywhere. It's not just us. It's happening in France, in Italy, in the UK, in Germany, in Asia. Politics getting polarized everywhere. The outcome is unpredictable, and it's not helpful for the investment horizon. It's the technology, artificial intelligence. It's something we have in the way in the world. We have no experience with AI. We can build theories about its impact. We know there will be an impact on employment. We just don't know what it will be. And finally, it's what's very important to us, I think, it's the shifting dynamics between public and private markets. So the important thing to understand is beneficial and helpful private markets work for the systems, and not just us, but everywhere. Private markets, as they exist today, came to be mostly after the global financial crisis. So they're untested by the market cycle, still a fairly new asset class, and we don't know how the future will play out in private markets. And finally, the unknown that gives me the most worry, it's on the right-hand side of the page. It's the unknown unknowns. So everything we just talked about so far, we could have said in 2019, before the pandemic, before the war, before the inflation. So all these uncertainties were around, they're known. Much like 2019, we didn't know about the pandemic. We don't know what the future will be. We know there will be disruptions. So as uncertain as it is today, the future will be probably even more complicated.
And can I just make a quick comment about your remarks around AI? I read something last week. It was a headline. I didn't read the entire article. It was from Bill Gates forecasting 300 million jobs lost around the globe, an increase in GDP for the world 6%. over the next 10 years associated with AI. So that, I mean, that's just a wild prediction, but from a pretty decent source. So just the food for thought as we think out, 7 to 10 years, if that were to come true, that would be very, very significant in terms of impacting your potential opportunity set.
Ed, can I ask you a question on the previous slide, the real GDP growth theme? Something seemed counterintuitive and seemed kind of important. I'll do it up there. Yeah, so where you say in a slow growth environment, it benefits growth equity or value stocks. This kind of seems counterintuitive. And then likewise, under fast growth, value and small cap stocks deliver better returns. I can see the smaller cap stocks returning. They said that, but in a slow growth environment, how does that benefit growth equity?
In a slow growth environment, interest rates tend to stay low. So it's not just interest rates, also the stock dividends, any sort of carry will not provide enough. So if not for carry, you need to look for capital appreciation. So it's naturally pushes investors towards more speculative investment. I don't mean in a derogatory way. By speculative, I mean more uncertain, that may give you a chance of higher returns. That's exactly what growth is, right? So think about think about Amazon, right? So now obviously Amazon owns the world shop on Amazon. But in the mid-90s, Amazon was just a weird company with weird name that never made profits, and people had strong concerns it will break even. There were other companies at the same time. Most of them disappeared. Right? That's growth equity. It's potentially high return, but it's also high risk. But in the environment of low carry, if you need to deliver your target return, you have to go more risky, more speculative. That will push us high. Yes.
We had a question, Patrick, down here. Was just curious about stagflation and how that fits into current thinking. And falls between the slow growth, high growth, inflation.
We're getting there.
Getting there. Patrick.
Yes. 2 slides. Okay, so just going back to uncertainty, let's just speed up a little bit. So I mentioned before that uncertainty is increasing. It's a measurable effect. We know that uncertainty is higher. Why is it so? There are actually reasons for it. The objective reasons why uncertainty is high and increasing. First of all, we talked about China. As China is approaching point when they need to restructure the economy, they have no blueprint. There's no guidepost. So when China was engineering its transition in the 80s and the 90s, China actually started experience of the United States, experience of the Soviet Union, experience of Japan and South Korea. There are no more blueprints. China is in completely uncharted waters. We mentioned unresolved regional conflicts globally. Obviously, Ukraine and Russia was a little bit unexpected. Taiwan, we've been debating it for the last 10 years, but one of the most widely anticipated conflicts. But again, these conflicts are everywhere. Natural resources. So the access to natural resources gets more complicated. Mostly, partly because of the climate transition, there's more demand for rare earth materials. Rare earth materials are actually not that common. They're actually quite common, but they concentrate in several locations. So access to these rare earth materials, it's most Latin America and Africa, drives a lot of conflicts around the world. And the rising income and wealth inequality globally at the national level creates a lot of uncertainty, as it increases level of debt and reduces the consumption. There are growing trade and fiscal imbalances between the countries. So if you think about developed and emerging markets, probably a more natural state of being when developed economies provide capital for emerging markets and emerging markets use this capital for manufacturing. That's not how the world is structured today. It's maybe counterintuitively the main source of capital globally are the emerging market countries. It's China, Indonesia, And the developed countries, predominantly United States, UK, Canada, actually importing capital. It's the global warming and climate transition, which is kind of slow moving train, but we clearly see the impact through our warmer winters and high level of hurricane. And goes back to what Steve just mentioned about artificial intelligence. I mean, Bill Gates has an estimate, but he's guessing. Nobody knows. We know it will be a huge impact. We just don't know how it will play out. So how can we express this radical uncertainty views? How can we incorporate this into asset allocation? There are ways we can address it. Probably the best way is to be diversified flexible by capturing the proper number of assets and the flexibility of shifting between the assets. We can correct for the events as they evolve. We may think about the frequency of the SA update, the exercise we do now. Should it be once a year, once every 3 years, or once every 10 years? We can use a disciplined rebalancing process. We may consider the use of active managers. Again, I'm not advocating this for another, but active managers may provide an opportunity to adjust for the uncertainty. We may think about new opportunities expressed through alternative asset classes. I don't mean just private equity or private credit. It could be CTA or trend following strategies. It could be digital assets. New ways to expand view. Again, think about private equity in the 1990s. It was a weird asset class that people were careful to go into and deliver excellent returns. There may be an opportunity to express tactical views. Again, not advocating this way or another, but tactical views may provide an ability to mitigate uncertainty. And probably one of the most important parts is engage staff in education. So as the world keeps changing, it's important for all of us to stand up and understand the consequences. So if we put it all together, let's back to what Steve mentioned earlier for the next week. So if you put all these three themes together, and it's a simple table that the horizontal left to right means the GDP growth, left means GDP slowing, the right side GDP accelerating, and the vertical dimensions is the interest rate monetary policy. Inflation accelerates down and inflation decelerates up. So if we think about these four market regimes, starting from the top left corner, stagnation, when you have low growth and low interest rates, maybe somewhat similar to what we had after global financial crisis. So in this environment, rates may benefit, credit will help, growth equities will provide better return in private assets. What will detract? Commodities, value equities, and emerging markets will not deliver good returns. Hedge funds are unlikely to deliver good performance. At the bottom left, we have stagflation, not the environment where you want to be. Yeah, this is the environment of the 1980s. That's when the growth is low, but inflation is high. What helps in this environment? Very little. Cash. Cash is your best friend. Maybe hedge funds. What detracts? Everything. Everything that sells off. Where you want to be is this so-called Goldilocks environment, the upper right corner, when the growth is accelerating and inflation is low. This is the 1990s. That's probably the best environment to be in. It's what we call everything Crowley. Like you cannot make it at all. Anything you buy will go up. The negatives, cash, and maybe in hedge funds. And finally, the overdrive environment, where inflation is high and the GDP is accelerating. And that's a somewhat unusual environment for the economy. It's mostly because of the impact of the central banks. If the economy enters this environment, central banks tend to hike rates, kill it. But if we end up in this place, value equities will tend to perform better. Commodities will probably deliver better returns. Hedge funds will be positive. On the negative sides, the growth equity will track. Where we will end up being, that's the uncertainty. That's our third thing. We don't know which quadrant will come back. Stop there. I think that will dive more into the mechanics and details of how to think about consolidation.
I had a question that, when you talk about cash, is that something? When you tell hedge shows the cash, is cash you talking about as a separate asset allocation as an item?
Well, that's another question we need to discuss as part of asset allocation. So currently, there is no allocation to cash in the benchmark, in the strategic benchmark. Even though in reality, the system holds some amount of cash, either for rebalancing or for capital calls or their benefits. We typically maintain a low level of cash between somewhere between 0.5 and 1%. That's always there.
Actually, technically, we have zero allocation cash, so we try to really minimize that. The cash tends to be more of a tactical asset, like it's going somewhere. So Doug asked the right question earlier. In this environment, we can get 4.5, 5, a little over 5%, maybe in cash-like instruments. Why wouldn't you increase your allocation there, or have some allocations tactical? But as a general matter, we're really not we're not constructed to make tactical investment decisions. So what we've been doing, we've had a lot of debate internally, is we've been adhering very strictly to the targets. We rebalance the targets, not weekly because of cost, but at least on a monthly basis, we try to pull back close within 1% of the targets. As a general matter, to be more tactical, we've taken the approach that time in the market, not market timing. I don't think many investors can do that well. And those that can do it have an information advantage. And we're in an open format, but like a BlackRock or a Goldman Sachs or a Blackstone or Apollo that are in the markets every day, they're underwriting deals and see flows from both retail and equity investors. They'd be better positioned to actually take advantage of those tactical trades. But we really don't have that information advantage within the Bureau of Asset Management. We've got very talented people, but I don't think we have an information advantage that would enable us to do tactical trading position very, very well.
But is there a space for that? And if there is a space for that, that lowers risk currently at 4.5%, I think it's easier to get to the 7 we need to get to. How do we get to that point where you guys
So
can't do
let me
it,
just,
but maybe
let me
someone
just
can?
interject from a timing standpoint. And let me just say this, if the boards collectively are willing to pay for things, we will figure out a way to hire the right people to do things. But let me just be clear about that.
It's all about the net, my friend.
No, and I'm just making that point. If there's a decision that the board collectively and this board individually would like to make that would involve restaffing or refocusing the controls office, I'm sure we're interested in having that broader conversation.
John,
I'm just mindful of the fact that some folks have indicated they have a time constraint today. So that's why I'm cutting off Steve, is to just
I was wondering why, but okay.
yeah, just to be mindful that just being mindful that Doug still has a presentation, and then we have an executive session as well. So
What's the time constraint? Is it 1 or is it 12?
so closer to 1, I believe, but
Okay. Great.
just being mindful. It was 12. So Schumann, I believe you had a question.
yeah, I mean, my question was really about, does it make sense to have a cash allocation where you can, you can make, not to develop a marketing timing, a tactical asset team. But short of that, that would make rebalancing a little easier and give maybe a bridge between equity and bond.
Yeah, it might make things easier, only because, it's kind of a fantasy that we have a zero allocation cash, and yet we always hold some cash to make capital calls or distribute or benefit payments, more importantly. I don't know, I'm going to defer to Doug. What do you think about a cash allocation, this type of fund?
Well, I think it's fine to have a 1 or 2% cash allocation because it reflects the reality of how you're managing your cash flows across, 12 asset classes. But I think you can frame the idea of whether we should be tactical in a different way and say, our whole fixed income bucket is supposed to be our relative lower risk, I'm using air quotes, bucket to offset equities or complement them depending on your point of view. And we just had couple side conversations earlier about the correlation, but set that aside. You can look at the asset allocation process and decide with those 5 or 6 buckets in fixed income, how you want to address the duration of your fixed income, right? Whether we have a 4% or a 5% allocation to cash, and then a bunch of other things in the fixed income bucket, you're still blending those together to get a lower sensitivity to interest rates, which was one of the key risks that Ed talked about in his risk report, right? And it, equity risk, which is kind of the catch-all bucket for really anything that's not a bond, right? When we're in the bond category, we're lending people money. We're subject to interest rate risk, which we separate from credit risk, which is the risk of not getting paid back. And then in the equity category, that's the broadest. That's where you own things and you collect carry or rents or whatever you want to call them. And that's an income stream. And generally from the equity category, there's more volatility in the income stream. And we want to get paid more for taking on that risk or volatility, whether it's, buying a treasury bond versus owning this building. We might be happy earning 4% with a treasury bond or 5%, whatever. And we might want to earn 9% yield from the rents in this building after expenses, right? And we might have leverage as part of that equation too, right? So those are broadly how you think about the portfolio, but on the idea of being tactical, I think really in reality, the only way for you guys to be tactical is to allocate more to the hedge fund category. And that's really because you already have managers that have a shorter term time horizon, what they're doing with their portfolios. You mentioned a few of the managers just a second ago. Those trend following managers tend to be counter-cyclical. They delivered in spades last year, great year for hedge funds. You've been getting the similar volatility of the bond category with much lower or almost non-existent sensitivity to rates. So that's something, the basket clause existed. We had hedge funds. We stuck with them. Only police and fire stuck with hedge funds. We had to trim hedge funds 2 years ago because of the interpretation of the basket. That's one of the things on the table to increase, right? And that's something that, depending on, the optimization and all the other things we're going to talk about in the next 6 months, that step alone can lower portfolio risk overall, but it certainly can lower portfolio risk to interest rate sensitivity as part of that, depending on what we do with the other pieces, right? And there's a long-term element to decision-making here, right? We like private equity. We want to continue to build it. We're going to have a conversation about what the size is of the piece we're trying to build. Is it 8%? We're going to stick with that, or is it higher because we have comfort level with it long-term? Same for real estate. And then the stocks and bonds, and more liquid parts of the portfolio, we're going to look at those as well and look at the duration on the bond part of it. But those are also the levers that offset any changes to the illiquid part of the portfolio. So that's kind of at a high level.
I think that's right. In terms of you can outsource, and we do outsource that kind of trading the
Yeah.
hedge fund, which is unique to your point that fire and police.
The complexity there with what the hedge fund managers are doing is high. And Neil and his team and Axia have a handle on that. There's leverage there. You have to be aware of what the managers are trying to do. And then we've taken the approach of reducing the risk by pairing managers together. We know that one manager might kick butt 1 year and they may be down 20% the next year and vice versa. But we want the pattern to be kind of what we're seeking through the grouping of the managers.
And that's the only part of the portfolio we have commodities exposure. We do have CTs.
Yeah, other than the fact that you have commodity sensitive equities. You have companies in the S&P 500 and the Russell 1000 and the ACWI that the price of their stock rises and falls with the price of the commodity basket that they are selling or producing. And so that sense, there's no, in the marketplace, there is no easy way to buy inflation protection. It's always, you've got to look in different places, like combining tips with commodity futures, with commodity sensitive equities, with real estate and infrastructure on the private side that have the rents have inflation sensitivity. So there's no easy way to do it.
So if we could, maybe that's a good segue to hop into your
Yep.
presentation and look, mindful that we have, constraint, for this. After the meeting, Steve's gonna stick around while we have, for a few minutes. So if there are questions that we haven't addressed or we don't get time to address about staffing and building things out, I think we should be encouraged to have those conversations. I'm just mindful of the time constraint this morning on getting this meeting done.
Have we really gotten to the point where you have to smack your microphone to get it working?
Yeah. It worked. It worked. It worked. So
So-
Doug, with about any,
Well, I think my presentation builds on some of the concepts that Ed and Steve have talked about already. The presentation, the itself has about 50 pages, but about half of that is an appendix. So I'm going to go through about 15 or 20 pages and try to do it in about 15 or 20 minutes. But, we may generate some questions. And yep. You can load it on the screen. I'm going to call out the pages that I'm referencing for anyone that is dialing in on Zoom. As long as you have the Adobe open, you should be able to work through it, but they can pull it up too, and I'll call out the pages. I won't try not to skip around too much, but just start on page 3. There's a quick overview discussion, which, summarizes the fact that we've begun this process. But I wanted to highlight a couple of things on this page. One is that last year, I'm 52 years old. I've been involved in investing since, depending on your point of view, about 1992, which wasn't too long after getting out of college. And I've never been in a market environment where bonds have sold off more than 10% and equities have sold off that much. Steve's a little older than me, and Ed might be a little older than me. I'm not sure. But the last time we've had a market environment where bonds have sold off even a little bit was 1994. So it's been a long time. So that is unique in the sense that we haven't experienced that as investors in a long time. But there's also some pages I'm going to go through here. It'll give you some context for the history, right? We talked a lot about, are we looking at history to give us insight into the future? Yes, we do look at history to give us context and insight into the future, but we look at market conditions today and other things. And I'll talk a little bit about that in the assumption section. But I would start by saying, as a belief system, I don't think any PC, and I don't believe Steve or Ed believe that any one of us can predict the future. We can look at lots of context from the past and say, wow, we know in the past that this condition or this circumstance has been a headwind for markets, whether it be the markets has traded up and they were very rich, means it's a headwind for the next 5 to 10 years. That those straightforward kind of drawing the lines makes sense. And I think it gives you a lot of context. And it is input into how we think about the asset class assumptions. But we don't believe that there's anyone in the marketplace, even some of the folks that trade for a living that are trying to be market timers, they do it in a very narrow sense, right? They're not trying to market time between real estate, private equity, bonds, and stocks. They're usually trying to time narrow government bond markets or currency and government bond markets or what have you. So the basket clause relief gives us a lot of extra room to revisit some of our past decisions, our current positioning, and talk about these trade-offs, whether the trade-offs be, the total risk that we're projecting in the portfolio, the interest rate sensitivity itself, or the liquidity and some of the other things. And it does give us greater flexibility. And I think we're going to examine lots of different potential incremental changes and talk about the trade-offs of those over the next 5 to 6 months. If you go to the next slide, just quickly on page 4, I think we've talked a lot already about the interest rate cycle and, the impact on the uncertainty, right? Uncertainty is definitely higher because the Fed is trying to react and adjust and tamp down inflation. And to do that, they're trying to slow the economy down, right? We still have some great strength in the economy, but things are starting to change. We're seeing that incrementally month to month with some of the data. Some of it is still perplexing and some of it is clear that things have slowed down. And having interest rates rise by 2 or 3% in a 12-month period is going to do that. But I think we're just starting this journey, right? And it's something that we'll provide some more context on. And when it comes to interest rates, again, 40 years of falling rates have definitely become the norm for a lot of people in terms of investors and how they think about things. And there'll be that adjustment going on as people think about their portfolios and the impact on inflation, GDP growth, but also these geopolitical events. Page 5 has a very narrow short-term chart on US inflation. Just shows you how quickly it ramped up from the end of the first COVID year of 2020 into the end of 2021. And that's really when this interest rate cycle really began, because if you remember in 2021, the Fed was very focused on inflation being transitory, and then they started to realize that that might not be the case. And it was getting a little bit more embedded in things. And so the big question the market wants to understand is, if the Fed's saying we're going to get that chart on the right side back down to 2%, are they going to get it back down to 2% in 2 years, in a year, in 5 years? Are they going to change the 2% and say we're going back down to 3%? All of that weighs on the bond markets and investors and corporations that are investing in higher. If you go to the next page, 6, the interest rate super cycle, I put some commentary in there just to kind of reinforce. When this chart from 1982 is trending down towards really 0% Fed fund rates and a 10-year that was around 2% at its low point, maybe a little below that actually, you can see that on the far right, that trend has started to reverse, but it's in the context of that history of that 40-year cycle, you can see that the reversal so far is not that significant. And I'm going to tie it into another chart in a second after I go through a couple here, but when rates are falling, it's generally good for corporations. They can refinance their debt, they can borrow more, right? As mortgage investors, when we want to buy real estate, we can afford that bigger house at 3% than we can at 5%. And all that's starting to kind of reverse. And it's not, that process is not tied to calendar year periods. And I think that, you should expect the next, 2 years or so to be a bumpy ride. We've already seen a little bit of that with banks, right? The Silicon Valley Bank issue is a narrow thing, but it really kind of is a symptom of 2 things. One is that as rates start to rise, banks can lose money on their assets, including treasury bonds, right? And so that hurts their capital base, and people worry about the banks and their safety. But there's another part of it, which is the banks that are paying you or your mother or your retiree that when they're paying us on our checking accounts or our savings accounts, very little, under 0.5% crediting rate. And we look around and we say, wow, I could buy a 1-year treasury or 2-year treasury and earn, 2, 3, 4%. That is going to put pressure on banks long-term, right? Will money migrate to the bond markets? Will they migrate to mutual funds? Will the banks be under pressure because their business model is the way it is, where they're trying to pay lower rates to depositors and lend out at higher rates? And now depositors have an alternative. And that's something that we'll see that play out over time. The next page 7 is to give you a little context on this bear market for equities for the S&P versus others in the past. Again, they don't always follow a 1-year cycle or calendar year cycle. And we put them all back to that 0 line for when the starting point was, to show you how some of those markets performed over extended period of time. The trading days, going beyond the middle of the page to the right means it extended beyond 2 years. But you can see that the big bear markets of our lifetime, so most of us have been around and since at least 1970 or 80. You can see that, the different periods of time, the great financial crisis, the 2007, 2009 is in there. You can see how low the bond, or how much the market corrected in that short period of time. The 73, 74, I think that was called the Nifty 50 correction, and the 80 and 82 correction, as well as the dot-com era, the 2000 to 2002. That's just context. The same numbers are on page 8, so I won't skip those. I will skip those, I mean. But as we look at our capital markets assumptions, and I'm going to go through those in a second, there's a highlight on page 9 is because rates are up and the bond market, the equity markets have started to sell off. Generally, asset pricing is more attractive, meaning the future expected returns have gone up. And that's good for us generally because we were really at a trough. Your expected return, I think the last time we did the asset allocation the discussion in 2021, you know, we were expecting that your 10-year outlook for your returns was closer to 6%, and the 30-year was just under, I believe, 7%. So it was lined up with your actuarial assumption, but it was certainly strained. And now that you can see the year over year from 2021 to 2022, how much the expectation for cash and treasury rates, other fixed income, and then equities has increased, that's all to the positive for us and makes our discussions easier about the levers we're going to pull with that extra basket clause space and in that discussion that's involved. I'm going to go quickly through the theme section. You know, we just talked about stagflation. I think that's one of the things that we think is one of our themes about our biggest worry is that will be a period where the economy slows and you know, the Fed is trying to do that right now. Whether we go into a full recession, a deep recession, a minor recession is anyone's guess, right? There's lots of views about that. But certainly a recession with inflation and rates going up is going to be something that we haven't experienced in quite some time. And really, I think since the 70s. And so, you know, when we think about the Fed's path and the idea of recession, we think that the unemployment and the wages are going to be a big part of that. At what point do wages start to flatten out? At what point does unemployment start to tick back up? And that will help guide the Fed. And they're very, you know, they're very dependent on some of those key things. You know, the other themes here, I think some of them are I would put it as a little bit less important. The European energy transition, I think a lot of that has already happened. The European market was did a very good job transitioning away from Russian energy. They haven't fully done it, but they made a pretty good dent. And it actually was very interesting because a lot of the energy that Russia produces really just shifted from one buyer to another group of buyers. It certainly is now being sold at a discount to the, you know, to the global price of oil and natural gas, but that's something that's already happened. China reopening is a theme of ours. It's really a theme about the condition that might drive market performance, you know, for the emerging markets, but also for developed markets. And then the US dollar, we talked about that a few minutes ago. We've got some slides in here on that I'll cover. If you go to page 13, there's a chart that I think is helpful in understanding the context of what the Fed is talking about, right? Is that relationship between the Fed funds rate, that cash rate that the Fed has the most control over, and their job of fighting inflation. When that cash rate, it has a relationship between inflation, meaning, you know, I think historically you could have decided to put money in cash in the 70s, 80s, 90s, and been able to get roughly the rate of inflation from your cash, meaning that on a real yield basis, it was close to zero for cash. We had a period in the last 12 years or so, 15 years, where the Fed kept the cash rate much below the rate of inflation, right? Close to zero, even though inflation was hovering between, you know, 1% and 2%, and they still had that 2% target for inflation. This chart looks at where that relationship ends up after the end of a policy tightening cycle. And so what the Fed is trying to do is kind of is map, if you will, the fall of inflation back towards where their Fed funds rate is, right? So they realize that they can change the Fed funds on a short-term basis, but the inflation is a little bit more of a long-term thing to try to control. And so as they raise rates and the fall-on effect in the interest rate markets and on borrowers and consumers, as that starts to slow the economy, they believe inflation will come down. And oftentimes when they've gone through this process in the past, you can see that that inflation bar, the CPI, the darker blue, typically ends up below the Fed funds rate. And right now it's still much higher. So when the Fed keeps talking about, even when Silicon Valley Bank fails or something else is going on, and they stick to their knitting and they do a 25 basis point increase, it's because they have this kind of longer term goal in mind. And they're generally more worried about inflation being sticky than they are necessarily about something going on in the short term with one bank or maybe with the stock market. I'm just going to go ahead to page 15. Yeah, sure. Well, remember, they're both moving, right? So the Fed, I think the market right now is pricing in maybe one more increase of 25 basis points, but that's dependent on how much those monthly prints, right? We just finished March, so we're going to get our next inflation print either, what is it, next week, I guess, or the following, whenever it comes out. They're hoping that the CPI number continues to come down, right? So we're showing that on the far right as a comparison to the other ones, which were cycles that were completed, and this one is in process.
Doug, this is Eddie Brown. But the job numbers, when you watch them, I was watching something the other day. So they keep laying, you see all over the country, all these people getting laid off, right? In tech and all over the place, right? But what they're finding is that these people that are getting laid off are getting other jobs immediately. So it's not really changing the job market.
Well, yes, you're right. The job numbers are a collection of things that are going on simultaneously. And right now, the Fed is most concerned with the number of job openings that are still out there that are unfilled. And it's a significantly high number. And so part of what they're trying to do by slowing the economy is they expect many of those job openings will be taken off the table, right, over time. Some of them will get filled, even as others are laying off people. And what's the kind of aggregate effect of all of that activity is right now it's still low unemployment. But if those jobs in waiting or those demand for jobs goes down at the same time unemployment or other layoffs happen, and those jobs aren't filled, that's when you'll start to see that employment rate tick back up. The other thing that's been happening is
you have these people that are getting laid off, and then they're getting packages when they leave, right? So they're not getting unemployment, and by the time they get the package, they already have another job.
yeah, I mean, I think when there are mass layoffs in the tech industry in particular, you're right, those individuals will get packages. Some of them may get a job right away and they keep their package, right? They get a lump sum severance package, which is typical. And, 3 months, 6 months, whatever it is, 12 months in extremes. And they may decide to spend that, or they may go out and say, I'm going to get another job. And then that money is now extra money that I can spend. And that may, have a positive effect on the economy. But I think that's pretty marginal. I think, the Fed is focused on getting the number of open jobs down and then slowing the economy to the point where there'll be more people that are out filling those jobs because they've been laid off. In the interest of time, I'm going to go ahead and, I did have page 15 is just an interesting chart that goes to the question that was asked earlier about correlations, right? That when we combine the portfolio over time, we've always expected bonds and stocks to have that diversification benefit, which was reflected in generally a negative correlation. And over time, we've had long periods of time where when the stock market sold off, bonds were positive, right? Up until last year, and you can see this 3-year rolling correlation. The correlation between stocks and bonds for the last 20 plus years has generally been negative. And then in 2022, they were very much positive, meaning they both sold. And the part of that's from the starting point because rates are at a very low level. COVID was kind of the icing on the cake for a low rate environment. And then, the Fed kind of jumped in hard when COVID hit. We were already at a low point talking about how low rates were, and they went even lower because of your reaction to COVID. And then you've seen that kind of start to reverse. I'm going to go ahead and jump to our assumptions. There's a section in here that talks about the recession outlook. I think we've talked a lot about that and the Fed's intent there. But generally, they're focused on unemployment and wages and that being a source of slowing of inflation. And, I know from our experiences in my own company, the raises that we were giving to entry level and junior people in the last 2 years were astonishing. I mean, some of them were 15-20% in different places. And, we're in financial services. Maybe that's not a great, it's not the same as a tech industry. It's not the same as, hospitality industry, but the demand for people and their ability to go, reject an offer or ask for more when we are offering them, right out of college, what we think is a strong salary, that the wage inflation was very strong. And we are seeing that start to, to weaken again, which is good, I think, generally for the economy. But that's a big part of the recession outlet is thinking about unemployment and wages. So there's also some slides in here on the dollar. In the interest of time, I won't go through those, but I think we can probably come back to those and talk about those later on when we talk about some of the asset allocation, the more detailed discussions when we start looking at asset allocation mixes and talking about the non-US part of our portfolio. So I'm going to go ahead to the asset class assumptions, which start on page 25. And again, as context, we don't believe we can predict year to year what the markets are going to do. We have a 10-year time horizon that we update quarterly. So some of the big inputs, in the interest rate side, we look at Fed funds rates. We look at all the different yield curve points on the yield curve. We also look at the futures market for what the bond market is signaling about the next 3 to 5 years. And so when we look at, again, year over year, the increase in yields in public fixed income have driven a lot of our assumption changes. If you go to page 26, there's an overview about how we develop them. So, again, a key input in terms of market data, it isn't just about the performance of the markets going backwards. It's about the current pricing, which is in the fixed income market reflects the yield, in the equity market is reflected in the PE, and thinking about those kind of relative to history. Again, as a 10-year time horizon, but we also have a 30-year time horizon. So the assumptions are in the back and you can see the difference. The 30-year you can think of as being more smoothed out. So less reactive to year condition changes, but certainly still anchored in those current pricing. And the 10-year is more likely to move a little bit more in reaction to, changes over the course of a 12-month cycle. Page 27 talks about our methodology a little bit. I think Ed did a good job of talking about how the different consultants have slightly different methodologies. I think ours has been pretty consistent over time. We certainly pay attention to, making adjustments to it if we think there are any inconsistencies in it. Again, trying to come up with a 10-year expectation. One of the things that we look at and think about in our forward-looking methodology is what are the components of return? And when you think about any asset class, when you look at various asset classes, they all have kind of one of these 5 key components. And so when you start at the bottom, yields in the fixed income markets, the yield, start with the cash yield and you build up from that. Yield is driven by the duration of the bond. So cash yield, if the cash yield's 2% and 10-year treasury is generally going to have a higher yield other than when the bond market's inverted. And that's a key driver of the expected return because over time, 85 to 90% of the return from bonds is going to come from that yield. And there's also these relationships between other asset classes when you think about yield as an alternative, looking at the earnings yield on stocks. So when you think about the components of the equity-oriented asset classes, the real growth rate, the impact of inflation as a baseline for all asset classes, the valuation metric, and then the illiquidity premium for some asset classes where you're giving up liquidity. And that's really simple to think about. If you think about the idea that we can buy the S&P 500 and it might be trading at 18 times earnings, when you go into the private markets, you'll see and hear from your managers that they're going to try to pay a lower multiple. And that's in part because they're locking up their money and owning a company that's illiquid. And so they may try to buy a company at 7, 8, 9, 10 times earnings. And that's one actual practical way to explain the liquidity premium is to think about the fact that your private markets managers, they may have a design on growing the company faster than the S&P 500 grows. That may be part of their thought process, but they still want to pay less for earnings. So that illiquidity premium is reflected in their valuation. They're thinking about that. The asset class assumptions for most of the key asset categories are on 28, and we've got them compared to a year ago. So you can see the difference. And because we've been talking about how the opportunity set is much more attractive, in particular in the fixed income space, you can see that our return assumptions for equities, public equities, are still relatively low. Under 6% for everything but emerging markets a year ago, have now kind of come up closer to 6% for most categories. Again, we believe emerging markets have a little bit of a higher expected return. And then when you look in the fixed income category, you can see most of those have increased by at least 2.5% or 3%. And that's really been driven by the cash rate being up by about 2.5%, because again, it flows through into the assumption for all the other bond categories. And this is just a sampling here. US government treasury bonds, you can see now expected to earn over 4%. TIPS, which have that inflation protection, they actually have a little bit of a lower yield, but they are expected to return over 4.4. Private debt, which is what we use for your OFI portfolio as a proxy, up over 2% to expected to return over 8.8%. These are designed to be expected returns that do not include active management, which is there's a little bit of explanation when you think about, I'll talk about US stocks, for example. It's supposed to be a passive implementation, for example, owning the Russell 1000 or the S&P 500. When we talk about private equity, there is no passive option here, but you can see that our expected return of 9.2%, all that's designed to do is to use as an input the expected return you're getting from that illiquidity premium. So again, if the US large cap is 5.4 and private equity is 9.2, the difference is primarily from that illiquidity premium, which is different than your managers trying to add value and trying to earn 15 or 20% with the private equity funds that they run. So that would be the active management in our minds. And this is the number we use for modeling. We believe it's relatively conservative. We've had conversations with BAM about that and about how some of the other consultants' methodologies differ. We're certainly comfortable using a number for an assumption for private equity that's a little different than, a little higher. But clearly, when we hire managers, we're not looking for 9% returns. We're looking for, mid-teen returns on that portfolio. But in the context of this exercise, we use that kind of more pure and more conservative assumption for the return. At the bottom of the page, you can see the 60-40 portfolios with the ACWI and the S&P, and the hedge fund is also an example of an asset category that we view as multi-asset, and it's derived from the beta and other exposures that are inherent in those portfolios. So it's really a roll-up of different exposures that do have an assumption there for active management. So that's really the only one that has an assumption for active management. I'm going to pause there and see if there are questions. The rest of the presentation has more kind of building block summaries that give you more context for some of the different buckets like equities and fixed income. And there's some slides on our inflation assumption too, which we're using 2.5%. So the Fed is managing to 2 and we're using 2.5, which is a little bit elevated, but certainly is still much lower than the current inflation rate when you're looking at the short term.
So Doug, I would just ask respectfully that if any of the trustees engage or ask Doug to look at an additional asset class or an additional strategy, geography, specific type of product, that they just include the full board on that request, so that this way we're all on the same page and we're not doubling our efforts if we're asking questions about whether or not we should own real estate versus invest in funds and things like that come up periodically every time that we have this exercise. I'm just mindful that Ed is coordinating on behalf of BAM. Doug's doing his work. The other consultants other consultants of this board are also offering some input. Just in the sense of just knowing that we're all rowing in the same direction. If folks ask that a specific asset class get looked at, it'd be helpful if everybody on the board knew so that we were just all on the same page. I think we want to make this a collaborative effort. And that's the only thing I would just suggest that rather than inundate the Doug with like 6 requests to look at something, if one person has sent it, we don't have to, reinvent a second email and just to get ourselves.
Are you
on
just
record.
talking about in general, if we're looking to increase in one particular asset?
No,
class
I'm
that
saying if there are
or
things that are
some-
not in here, like commodities came up, if somebody actually wants to look at that and is asking Doug to do that, I just ask that everybody be included. We all know what's going on and that we're trying to do double work.
I would say my only question is simply this, 10-year return, December 31st of 2022. In your assumptions on page 28, you only have 4 asset classes above 7%. And how do those 4 asset classes drag the rest of those classes up to 7% for our current discount rate?
Well, so these are the 10-year assumptions. Your projected 10-year return for your portfolio in the current policy targets is 6.8. So it's a little bit below the 7. And so you're right. I use the ledger approach, right? You draw the 7%, you say what's on 7% side and what's below it. You do have healthy allocations to the private debt, the high yield, and private equity, but they, when you add those up and add it emerging markets, I think it's probably only 22% of your portfolio that's got that number over 7. Now, some of them are higher, and we're certainly expecting excess returns from private equity that are over the 9 in terms of active management. But you're right, there's a math problem there. With our 30-year assumptions, which are in the back, you can see in the appendix that you do comfortably get above 7%. And the numbers here are higher over 30-year expected time horizon. But it's definitely challenged still over the 10-year cycle.
And I know we are concerned about taking on more risk. Obviously, with risk, there could be bigger hits. So I'm looking forward to the conversation on how to at least get that number to 7, and curious if you believe that the additional room in the basket clause gets us to 7, or does this already include your assumptions for what we're going to do with that additional 10% in the basket?
So we haven't started looking at specific mixes yet with BAM. We're going to go through an optimization exercise to look at how you would get to the lowest risk portfolio at 7%, and then what the alternatives are across that, what we call efficient frontier. I presume that we can certainly add more risk to get above 7 on the 10-year. And there's plenty of room to do that with the basket clause now. I think Schumann and others have asked questions about new asset categories, adding a new asset category to the extent that it helps diversify the portfolio might help us keep risk low, but there's no real easy answer to get, to a low risk portfolio that's going to have, protection in a down market and get us a 7% return over the actuarial time horizon.
Just to clarify, as a recipient of these funds, I want the least amount of risk that gets us to 7.
Yes.
So I just want to note the one asset class that I don't see on here and it's unique to the city is the ETI portfolio, which I know we kind of put in with the fixed income bucket. But and that may require reaching out to the team to understand what their assumptions are, because it is a unique New York City centric product, and it's not a huge piece of the portfolio either at this as of today. That could always grow, but I would just welcome the opportunity to kind of fit that in, and that's one of those legacy programs we've been doing for a very long time. It does benefit the actual city and our members.
And I view the ETI program as an implementation target, right? It's kind of overlaid within the fixed income portfolio. We have typically modeled it as a mortgage backed sector investment. So you have, and I didn't put all the different pieces of the fixed income in here. This is really more a high level chart, but we've always modeled that as mortgage-backed security exposure, because that's primarily what you're getting from the three big buckets, which are the AFL CIO hit, the
PPAR program and-
RBC and the RBC Access Capital and the PPAR. Yeah.
Yeah, no, that's fine. I just wanted to throw that out there. I know that that's a question and a program that is actually something that we've been very proud of through the years. So, what are the next, I guess this is really a BAM NEPC question. What's the next steps as far as the board goes? What do you need from us or don't need from us?
I think it's actually to put these through your technology and see what kind of kicks out, what the optimal allocation
Yeah.
might look like.
Yeah, the portfolio optimization is something we can do it's very straightforward. It's a little bit of a blunt tool exercise, because ultimately when you put together an efficient frontier, you're really making decisions about how you're going to constrain parts of the portfolio, what kind of maximum allocations you assign to things. And you can do it on a really unconstrained basis, which is more of an academic exercise, and then start to slowly constrain it and look at how what the policy mixes that would come out of that would be. But it also doesn't always factor in other things like, the implementation considerations, governance time, ability to passively or actively manage the pieces of the portfolio that may be new or being considered. And so, generally we'll go through that exercise and, we'll have I think a robust discussion about how we might subjectively kind of either override that or talk about those trade-offs with the board so that they understood, that this model isn't necessarily going to drive what we're going to decide to do based on our comfort level with different asset classes or some of the things that aren't included in the model, like liquidity and our ability to implement something at all, right? Commodities are a good example. I think public pension funds have struggled, all pension funds have struggled with finding a commodity product that was, something that they could rely on in terms of its performance. I know my own experience has been that we've had commodity products in client portfolios for 10 or 15 years during a period where inflation didn't matter that much, right? And a lot of those products were negative returners for 10-year periods, and a lot of clients wanted to get rid of those, and they did. And part of that is that the way that commodities are accessed through the futures market. There's a dynamic there that's important to understand. And you would ask about convertible bonds, which used to be part of the portfolio. I struggle to understand why we keep coming back to talk about them, but it's a very small market. So I think relevant to an optimization is something that's not factored in is the size of the market and the makeup of the market, in particular commodity convertibles being very concentrated in the tech space and the return being driven by equity return, which you get exposure to from a big chunk of your portfolio that you have invested in public equities. But I guess if we're going to look at commodities, or if we're going to look at convertible bonds, I'd love to look at the CMBS market as a separate market, because that's actually a bigger market, I believe. So we can have those discussions, I guess, before we go through the optimization.
Yeah, and obviously convertibles, it's really you get 80, 75 to 85% of the equity upside with 50% of the downside. So the different risk reward proposition, but the question is, what's the exposure that the board, the trustees have to risk? And just a quote, I actually wrote it down. Howard Marks from Oaktree a couple of weeks ago quoted Warren Buffett saying he'd rather have a rough 12 than an easy 10. So, you're able to withstand a significant amount of price volatility, I believe. Some of the other public pension plans that are out there, there's one down in Texas that has fully 54% allocation to alternative assets, in particular privates, which, is in my mind, at least, is a little more of a challenging proposition. At the current level, maybe adding up to 10, another 10% up to 35, 32, 35%. I still don't think the liquidity is going to be an issue for your plan. And we manage that through your allocation to the public market.
Yeah, the liquidity, if I was a trustee, I think the first thing that I want to ask is, how much further down the path building our liquid portfolio can go. And I agree with Steve. I think we have more room to grow it. But I also see some of your peers have tried to put more than 45 or 50% in liquid assets. And that really does inhibit or limit your ability to rebalance in a more significant market sell-off than we've experienced. And you also, can put yourself in a position where you're struggle making your benefit payments if you're not careful. So.
I don't think you have to worry about us doing that at this fund, only because there's a caveat in the law that if the assets sink for I believe it's for one fiscal year below a certain percentage in publicly traded securities, the comptroller and the mayor get an extra vote each in investments. So I'm pretty confident that that's not going to happen at this board.
Well, the
That
basket-
we would go that far into
Yeah.
into that realm. Although, I mean, if you guys are willing, we
The
can always
basket still
discuss
does that too. So
Yeah.
the basket also limits
Yeah.
that too.
I would say that in the limited amount of reading I've done on this, we tend to be hampered by a mindset of thinking, not being able to think outside the box because we're comparing ourselves to everybody else and you get questioned if you make a mistake.
Yeah.
But I'm not looking to jump off a cliff, but I am looking to figure out how we get from 6.8 to 7. Just seems to be common sense to me.
Yep. And I don't think it'll be that hard to get to 7 incrementally, but we can certainly, with that optimization, you take the whole process and say, what would we do if we had a clean piece of paper, right?
So I think we're in a good place here. I think NEPC and BAM know where the board is concerned and things that have been raised today. I encourage them to go work collaboratively and come back to the board with updates as necessary. I'm also mindful that we have a public agenda, that we have an executive agenda. So with that, I believe we concluded the public agenda, and if I can, I'd like to make a motion to enter into executive session.
Second.
Any opposed? Hearing none, the motion carries. We are now in executive session. Please turn off the camera.
Sorry, I'm front running.
All right. During the executive session, the board discussed various investment matters. Now we need a motion.
And I'll make a motion to adjourn. Second, Jensen.
Any opposed? Hearing none, the motion carries. The meeting is adjourned.
Thank you
You
all.
all.